depending on how you get introduced to the fund is kind of where you start in the funnel too, which is a secret of the trade. I think we would see thousands and thousands. Some days I'd wake up and I'd have 20, 30 pitch decks in my Twitter inbox like per day, right? And those folks are going to start in a different section of the funnel versus if Ed introduced me to a founder, right? If you can find a warm way into a fund, always do it. It's just going to push you ahead in the process. If you put your deck in DocSend and you track time spent on each slide, projection is going to be the lowest. Email, as far as power ranking of most impactful ways to get in touch, warm intro from a founder. So a founder they've backed, right? Any VC really values the opinions of a founder that they've put money into. 2 would be another investor's warm intro. 3 would be direct email outreach, right? So if you do the work of finding their email, send them a thoughtful message. 4 would probably be website, but websites it always does get looked at, but that's probably just like the coldest of cold. Something I hate, and I think a lot of VCs hate, are if you have that slide that's this market is a $10 trillion market, so we just need to get 0.1% of it, right? And we'll have a unicorn company. It's like, okay, but anybody can do basic math like that. Like, what's your strategy? What's your differentiator? How are you going to get there? Like, I don't care about getting a tiny slice of a massive market, and that should not be a slide. No salesperson will let you get off the call without having an answer, without having a next meeting. As a founder, you shouldn't let the VC off the call without knowing clearly what next steps are, and ideally getting a timeline or a next meeting on the books.
9 out of 10 businesses I wouldn't say have the strongest founder market fit. That doesn't tell me that the person isn't capable and can't be successful. So it's sometimes hard in a presentation to show a team slide that like screams, these are the guys or gals that should be building the business. Do you discount someone if they can't showcase a slide like that?
No. I think there's a lot of different ways to think about it. Of course, if you're building vertical SaaS for legal industry and you're a 4th generation lawyer, it's probably a pretty interesting founder market fit, but you just need to see that they have some tie to the problem or some tie to the market, or are thinking about it in a refreshing new way relative to what's out there, right? I mean, does it make sense that Zuckerberg founded the largest social network of all time? He was a antisocial nerd at Harvard, right? But he felt the pain point. Founder market fit is kind of broad. It's like, do you have ties to the problem? Do you have ties to the market? Or are you thinking about it in a unique way? So I think, don't think that you can't build XYZ business because your great grandfather wasn't in that vertical. Some of the best opportunities come cold, and they come from people who have done pre-seeds of unicorn companies from cold outreach. So you need to pay attention to everything. A lot of times it'd be on the weekends, going back and triaging the couple hundred decks that came into my Twitter inbox. Wife is watching reality TV and I'm flipping through pitch decks. Immediately, just given the volume, you're looking for disqualifiers, right? Maybe your fund doesn't invest in a certain vertical, right? So you kill that. Maybe the people have already raised too much money. So the founders raised too much money. It's not a stage fit. It's not a sector fit. It's not a market you believe in. So you look for like quick disqualifiers.
What's up, guys? Eddie Mikes here. This is a recording of a live webinar I did with Blaine Davis, a former venture capitalist and now founder who's invested over $10 million into SaaS startups and recently raised over $2.5 million within 4 months of launching his current business. So our goal with this interview is to give you guys an inside look at how SaaS investors evaluate your businesses so you can position yourselves ahead of the ocean of competition that's out there also hustling for capital. So don't forget to smash that like and subscribe button, and I hope you enjoy the show. My name's Ed. This is Blaine. He's my guest today. Welcome to the Secrets of a $10 Million VC webinar. I'm going to hand it over to Blaine to introduce himself in a second. But just a quick run through on the format. We're going to do 30 minutes of an interview where I have some pre-arranged questions for Blaine, and then I'll open it up to the floor for live Q&A where you can ask him anything you want. Really, this is like a totally open forum. Don't pull any punches. Challenge Blaine, ask him whatever you need to ask him, your most burning questions. So without further ado, going to try to keep it pretty tight. We have a lot to get through. Blaine, I'll hand it over to you. Take it away.
Awesome. Thanks, Ed. Yeah, really excited to be here. I think looking forward to the Q&A the most. So definitely start firing off questions. But I'm Blaine. I started my career in the fintech space as a product manager in New York. After that, spent a number of years in VC. I went back and got my MBA before joining a fund as a principal. The fund's name is Outlander. I was there for 4 or 5 years before starting my most recent startup, which I'm at right now. While I was at Outlander, we had about 500 million AUM. We were leading pre-seed and seed rounds. So I think that that's most likely kind of the stage that a lot of you are at today. Early rounds, leading with checks anywhere from 500K to 2.5 million. Led about a dozen deals while I was there. Looked at thousands and thousands of pitch decks. I think probably rivaling as many as Ed has looked at over the last few years. So happy to answer anything and what sticks out to us, what got through our process, what VCs look for, what they don't look for. Anyways, did a number of deals while I was there. We were generalists, so marketplaces, B2B SaaS, consumer even, kind of running the whole gamut. I left Outlander a few months ago to start a startup. We raised $2.5 million pre-seed round. So in a lot of the same boat as you guys now too. It's a marketplace business, can chat more about it. We're operating in stealth currently, but can share a little bit on that experience today as well.
I think to start off, I want to paint a picture of sort of the realities of fundraising and how it works. So my first question is, can you walk us through what your typical deal funnel would look like? So how many decks are you seeing? Where do they come from? And then what does the transition look like from decks to first meetings, meetings to diligence, and diligence to closing?
It's very similar to how I think founders should run their fundraise process too. Very much a pipeline. Everything in life tends to be a numbers game, right? If you want to see the Stripes of the world, the SpaceXs of the world at the early stage, you want to meet as many founders as humanly possible. So at Outlander, we were trying to get as big of a top of funnel as possible. We met with or reviewed thousands of decks a year. I think realistically, maybe looked at, which was actually spent time in 5,000 decks a year, had first meetings with maybe 1,000 founders a year. And what that means, the first meeting, it might be a group pitch session where you have 5 minutes, right? So we're not spending an hour with every single founder, but top of funnel being as big as possible is key. Full funnel would be that initial touch point, maybe a longer hour-long call to diligence the deal, and then spending a few hours doing a deep dive on the opportunity, the team, everything related to the business before most funds have a partner meeting, which is where kind of everybody votes on the deal, come to an agreement. That's kind of the final stage of the process before legal diligence. So 5-step funnel. I think something that might be worth mentioning today, depending on how you get introduced to the fund, is kind of where you start in the funnel too, which is a secret of the trade. I think we would see thousands and thousands. Some days I'd wake up and I'd have 20, 30 pitch decks in my Twitter inbox, like per day, right? And those folks are going to start in a different section of the funnel versus if Ed introduced me to a founder, right? If you can find a warm way into a fund, always do it. It's just going to push you ahead in the process.
It's also like a function of the founder's time, right? There's only there's 25 hours of work in every 24-hour day. So obviously, warm introductions are significantly more valuable, but they take a lot of time to generate. So how should a founder think about, if they want to play the numbers game, but also maximize their conversion rates, splitting between cold and warm outreach?
Yeah, you definitely need to do both, right? Again, it's a numbers game on the VC side. It's a numbers game on the founder side. Some of the best companies struggle to raise their first round. You're pitching 100, 200 VCs. So maybe you look at your network and you say, let me get a warm intro to my 10 dream funds, right? Which, you're arbitrarily deciding who your dream funds are. Nobody really knows who they want to work with until you spend time with somebody. Say you pick 10 funds and you want to backdoor your way, right? You look for mutual connections on LinkedIn. You try to find somebody who knows them on Twitter. Otherwise, you should be running a process and doing cold outreach and A/B testing different messaging, different versions of your deck. Cold still works, to be very clear. I think of the dozen or so deals I did, 4 or 5 were warm, and that leaves majority being cold, right? It's just, I'm going to spend more time. It's going to be tougher. I would look at a couple hundred decks a month and meet maybe 50 to 100 founders a month, whether that's a quick call. So you need to try multiple ways to get in.
To react to your point about seeing like 30 decks in your Twitter inbox or email inbox when you wake up in the morning, what is the next step? Are you actually flipping? Are you actually reading these presentations? Or some of them, do you like flip open and you're like, automatic pass? Or what about the decks holds your attention? What gets someone to stand out from that stack of 30 that you're just overwhelmed with, in addition to everything else you have going on in your day?
Always looking at them, right? I think you'll hear from some of the very best VCs out there that some of the best opportunities come cold, and they come from people who have done pre-seeds of unicorn companies from cold outreach. So you need to pay attention to everything. A lot of times it'd be on the weekends, going back and triaging the couple hundred decks that came into my Twitter inbox. Wife is watching reality TV and I'm flipping through pitch decks. It's you have to love it, and you have to want to look through them all, and everything's interesting, right? So you give everything a look. Immediately, just given the volume, you're looking for disqualifiers, right? Maybe your fund doesn't invest in a certain vertical, right? So you kill that. Maybe the people have already raised too much money. So the founders have raised too much money. It's not a stage fit. It's not a sector fit. It's not a market you believe in. So you look for like quick disqualifiers.
Beyond looking for just disqualifiers, what can someone do to like really stand out from the field, right? Because I see about a deck a day these days with my business, and like a lot of them have a lot of the same issues. And I'm like, if you just fix like a couple of these things, automatically you will come off as more credible. What are some of those things that you look for, or that you don't even look for, that automatically make something stand out on that like humdrum weekend when you're just flipping through a stack?
If you're to trim a deck down, say what are like the three most important slides, it's your problem slide, your solution slide, and your team slide. I mean, you can figure out what the opportunity is based on the problem. Solution is how people are thinking about it, what they're building, what's the vision, right? Kind of ties into solution. And then team, right? I think it's different at like the Series B, Series C, but early days, you're investing in people. People are going to pivot. You want to make sure you're investing in somebody who's got great founder market fit, is thinking about what they're building in a very interesting, unique way, has good experience, and that they're, can bring something from their past life to their new startup. So I think all else aside, if I could have flipped through just problem, solution, team slide, I think probably going to get to the same results on who's getting a first meeting.
Yeah. So let me follow up on that founder market fit piece. I think a lot of first-time founders are guilty of this, me included. When I started my first business, like a lot of people dive into entrepreneurship because they like have the entrepreneurial seizure. They want to start doing it. They become compelled to go start their own business. And I would say 9 out of 10 businesses I wouldn't say have the strongest founder market fit. That doesn't tell me that the person isn't capable and can't be successful. So it's sometimes hard in a presentation to show a team slide that like screams, these are the guys or gals that should be building the business. Do you discount someone if they can't showcase a slide like that?
No. I think there's a lot of different ways to think about it. Of course, if you're building vertical SaaS for legal industry and you're a 4th generation lawyer, it's probably a pretty interesting founder market fit, but you just need to see that they have some tie to the problem or some tie to the market, or are thinking about it in a refreshing new way relative to what's out there, right? I mean, does it make sense that Zuckerberg founded the largest social network of all time? He was a antisocial nerd at Harvard, right? But he felt the pain point. Founder market fit is kind of broad. It's like, do you have ties to the problem? Do you have ties to the market? Or are you thinking about it in a unique way? So I think, don't think that you can't build XYZ business because your great grandfather wasn't in that vertical.
The Twitter sphere would argue to the contrary, which I think is a little bit misleading.
Yeah, and I think there's no perfect science, but some of the best businesses out there are because the founders leave behind like industry knowledge and assumptions where, if you're building something truly disruptive, there's probably people who've been in the industry for decades who are going to say that can't be done. And if you do it, that's when you build a massive company.
Let's say that you have a stack of decks where they don't meet any of your like obvious disqualifiers. What are some things that you see that within the confines of them being a criteria fit automatically disqualify the deck, where you're like, I see this thing, pass? What's up, guys? If you're enjoying this video and you want me to roast your deck using the same principles I use to raise over $30 million for my own businesses and my clients' businesses, click the link below, send me your deck, and prepare to get roasted. Alrighty, back to the video.
there's a few kind of like red flags in decks. Something I hate, and I think a lot of VCs hate, are if you have that slide that's this market is a $10 trillion market, so we just need to get 0.1% of it, right? And we'll have a unicorn company. It's like, okay, but anybody can do basic math like that. Like, what's your strategy? What's your differentiator? How are you going to get there? Like, I don't care about getting a tiny slice of a massive market, and that should not be a slide. What do you think?
I violently agree. Of course, it's just like good to hear.
I was like, you either completely agree or you're like, what's he talking about?
No, I totally agree. I think like top-down market sizing, especially when someone puts like a huge number on the page with like nothing to substantiate it, even if there may be a business there, it doesn't land well in the eyes of the reader, at least in my experience. And I'm like, the more sophisticated like winners that I see are often claiming smaller markets, but have a more robust narrative around the contextualization of their problem, why their solution solves that problem, and like demonstrating that they can get a big share of a smaller market or something like that. But the analysis they do to build their market size up from the bottom up is more compelling. So I totally agree. Anything else? Real turnoffs where you're just like, all right, I've seen this 1,000 times. This is obviously someone I'm not going to invest in. Pass.
There's a lot of things you can do in your ask slide that are non-obvious, but are turnoffs to VCs, right? So I think in ask slide is great here. How much money do you need to get to the next stage, right? What are you raising? Why are you raising it? If you haven't thought through your why, what the use of funds is, that's always concerning, right? It's like, I need to raise this money so that I can pay myself a salary. Of course, everybody needs a salary. But what's your plan? What are you doing the next 12 months? Why are you really raising the money and where is it going? Also, if you're declaring your terms and it's like, I'm raising 1 million on a 30, right? Which is no equity for the VC. You want to be realistic. I think everybody should know what you should expect to give up in each round, equity-wise, in your company for a standard VC investment. And venture capitalists are doing portfolio math too, right? They need to own a certain amount of business for it to work for their business model. You want all incentives aligned. I think it's like when it comes to the math and when it comes to use of funds, those are key things that are probably less obvious.
I often see people are in this chicken egg situation of, I need capital to drive growth, but I need to demonstrate growth to raise capital. Presumably you have a bunch of people coming to you who are like, I need capital and then I can generate a ton of sales and traction. What's your advice on how founders should handle that situation? Should they shut down their business? Should they tighten things up and do everything they can to generate traction before they ask for a dime? Or should they punt and try to go raise capital and just hope it works out and then use that capital to generate the traction they think they can?
It's tough. That's always a balancing act. You're spending money to grow at this stage. And that's the whole venture game, right? That's why you're raising money. The margins aren't going to work at the beginning. You don't have product market fit yet. So it's not a certain dollar for this that you're getting out, right? You're raising for discovery and you're raising to try to put fuel on the fire to grow. I think there's certain thresholds that you need to hit to be able to raise that next round, right? So I think if you feel like you're off target and you're not going to be able to hit a certain revenue metric, you need to kind of dial back on the growth thing. And there's always a balancing act, growth versus profitability. And it depends on what investors you're speaking to. Right. That's a whole other, I could talk about that for a while too, right? Growth versus profitability.
Yeah. Here's a more targeted question. How do you define real investable traction? Every founder knows they have to, if they're going to raise money, they need a traction slide, right? But what you put on that traction slide and what it actually means, there's like a huge spectrum. And oftentimes I see traction slides that like claim a lot of validation for a business, but it's actually not really that much substance in terms of action taken by the market. So if I were an investor, and I do invest in some startups, I definitely wouldn't invest unless I see like pretty demonstrable sales, at least at some level, and it's relative from business, and it changes from business to business, like what's required. But from your perspective, how do you define traction, and what is, as a rule of thumb, a bare minimum threshold you would need to see someone meet to even think about raising capital?
There's so many funds that will invest at the idea stage. And I think like true pre-seed funds, and it's always finding the right one, right? So that's how we were. I did multiple deals, pre-product, pre-revenue, finding the right partner who is fine taking that bet. And you've got to know it might not be, the terms are going to look different than once you have $1 million of revenue, right? But if you need to raise that money because you need to spend it to build anything, I think that's fine, right? There's so many different types and flavors of investors out there. You just need to figure out what makes sense
And it's a style thing. Like I personally would never try to raise capital on an idea with no traction and validation. I can't tell you why. That's just like kind of in my head. I wouldn't do it.
It's way, 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 way tougher. If you don't have nothing, just an idea, no traction, no nothing, you need to be that like brand name, like, oh, this guy went to Stanford, or this guy was at, he was somewhere before, right? To make it easy. Otherwise, it's going to be a slog. It's going to be a slog. It's not easy. So I think like whatever you can do to prove traction first before you go out, it's going to make it much easier. That's what we did. I was at a fund that was investing in companies with no traction, no revenue, no anything, but still before my co-founder and I raised this round on Super Connector, the business I'm working on now, we proved it out as less of a tech business, more of a consulting business to say, hey, there's a massive pain point here. We've validated that we can land customers. Like, let's go out and really blow this thing up and raise money and do it. So it was true proof points that this could be a thing before going. And that's having been on the other side of the table and backed people with no proof points. I just think if you can prove the market, prove that you're on your way in the right direction, it's going to be a million times easier.
Do you think it's often the right thing to do if you get to a place where you can't keep growing without capital, but the outlook for you to raise capital is very grim due to what we've just talked about, like the best thing to do might be the hard decision to shut down your business?
I think this is probably the only decision at that point, right? I think.
Yeah. So, I mean, I've personally made that decision and it's a hard one, but it's helpful for other people to hear from the horse's mouth that may be the only path forward.
I think when you know, which you can probably relate to, Ed, right? I think it's, you pour your heart and soul into your business. And at some point, there's going to be that moment where you realize that there's nothing more you can do, or it's the right thing to do to wind it down. And I think that's the toughest thing that any founder goes through, obviously, shutting down a part of you and something you've spent a ton of time on. But when you know that it's the right time. If the business isn't working, you run out of capital, you need to take a different route or restart or get a job, then you got to do it, right?
How do you think about the balance between founders presenting their like grand, big, sexy, take over the world vision versus presenting like super grounded, realistic assumptions about what's possible in their business and market in the near to intermediate term?
I think you need to be able to clearly articulate both. I think you need to have that kind of insane big vision that, hey, everything works. Where does this go? Creating a new market. I'm revolutionizing XYZ. But if you can't break it down to bits and pieces, it's never going to work, right? You need to say, okay, for me to get there in 10 years, this is what the next 12 months look like. This is what's realistic. This is what we're going to go out to prove, right? Which is going to look wildly different than that big, audacious vision. But the best founders can clearly articulate both in the same conversation, have both on their mind, right? What are you doing it for? What's the end game, but what's realistic in the meantime?
Yeah. And it sounds like presenting the big, sexy vision is almost a complete waste of time unless you can present realistic assumptions about what's possible in the near term. So I ask because that's a mistake I see all the time. It's like, all right, well, where's the business going to be 1 year from now? Okay, one question about reaching out to investors. A lot of questions I field from people are like, I just keep getting ghosted by investors, or I don't get any feedback, or it's unclear why it wasn't a fit. So what can founders do to get more definitive yes/no feedback, right? And caveating that they're okay receiving negative feedback and that it's no problem if the investment isn't a fit. It just, what is a problem is not hearing any feedback, so they can't change and adjust course.
I think the ghosting phenomenon is the worst thing going on in the VC industry right now. It's terrible. I tried to not ghost anybody. If I had ghosted any founders, it was because it truly slipped through the cracks. And we were very deliberate about giving feedback because that's how people grow. And you took time from founders and that's how it should be. I think what I see out there and why people are ghosting is VCs want optionality too. So I would almost, sounds a little bit backwards, but I would almost take that as a compliment, right? They want to not close the door because maybe it was very interesting opportunity, but not one they're ready to pull trigger on. So a lot of times people will just ghost. And then if they hear rounds going down, then they might reach back out, which is just, it's ridiculous. What you can do is send a thoughtful note and maybe ask about something that you discussed in the conversation and say, hey, enjoyed chatting about XYZ. Understand it might not be a fit right now, but would love some feedback as I push forward on the raise. And that should get you a response if somebody is good enough of a person, which that's another.
Yeah, which is not always going to be the case. So you still have to be prepared for a couple ghostings along the way. And then what about during a meeting? Just like on a sales call, I imagine with an investor meeting, at the end of the meeting, saying something more definitive, like, what do you guys need to see to move forward? Or asking them some definitive question that gets them to like pull back the curtain on what they're actually thinking, as opposed to just being nice and saying like, yeah, like we'll discuss it with our team. We'll get back to you. Like, let's find a time to set up a call. Like maybe a founder could be like, all right, how does next Thursday look for a call? And if they're like, I don't know, then you could follow up and say, well, okay, what do you need to see to schedule a call right now?
Absolutely. It's all sales. Everything is sales at the end of the day. No salesperson will let you get off the call without having an answer, without having a next meeting. As a founder, you shouldn't let the VC off the call without knowing clearly what next steps are and ideally getting a timeline or a next meeting on the books, right? What's your process? You need to know who you're working with too and how they operate. And you don't want to take everybody's money. You need to do your diligence too as a founder and ask them, what's your process? How do you think about this phase? What's concerning you? Or what are your thoughts right now?
How do you deal with an oversubscribed round? So if angels or VCs already agreed at a certain valuation, should you reach back out and ask if they're willing to go with a smaller check or increase their check and go to a higher valuation?
I think it's you can always go back and ask folks to adjust their check size for an oversubscribed round. It's tougher if you've agreed on a price, I think it's not so much a good look to go back and change the price. If you haven't agreed on one, then yes, by all means, go ahead. But ultimately, go and have that candid conversation with somebody you want in the round. Round's oversubscribed. I really value you. Is there any way you could drop your 100K check to 50K?
What does an effective team slide look like to establish credibility and create interest when you look at a deck blind? So something comes in cold, what kind of a team side would really capture your attention in terms of the information on the page?
Yeah, I think you want to see who's on the founding team, obviously, clearly, what's their background, the relevant components. I don't need to see Blaine went to Lehigh for undergrad, who cares, right? Where did I work? That's relevant. What did I do most recently? That's what's most important.
So the follow-up question from someone else was like, are logos and words much better for people's former companies and schools? It sounds like putting a university on there is not that helpful, and more like results-based stuff. Like, I got a job at this company. I was at this startup and we grew it from X to Y, like that type of stuff.
You want to know the very high level highlight reel and, know who's involved and maybe do some back channeling just to qualify and take the meeting, right? It's tough to relay that much information on a team side.
Do you think in a pre-seed deck, whether you're doing a safe or a priced round, which presumably you should never do and you should always do a safe, but regardless, should you put terms in the presentation?
No, it's only going to hurt you. I think ultimately your lead investor will determine the terms. They'll give you an offer regardless of what's in your deck. In all the decks I've seen it be a positive. I've seen some where I laugh at and say, how would that math work? That makes no sense. Or I've seen some where I'm like, okay, that seems within reason, but ultimately the term sheet's going to decide and the conversation is going to decide, because you might have 10 million in the deck, but then you have a chat with the VC and it's, oh, maybe I actually only need 5 now. Or maybe you have 1 million in the deck and they're like, I love this, let's do 3. And then it's going to be very different.
Okay, so follow-up question on valuation here. This question says, I typically don't share valuation until the end of the pitch. If we had a 15 million post-money valuation, but I was originally willing to take 2 million investment at 10 to 12, if I was okay taking less, but I was advised to start high with the third valuation because I anticipate getting negotiated down, is that good advice?
I think that this person's overthinking it. Figure out how much money you need, and you should expect to dilute yourself around 20, even up to 25% in a first standard pre-seed or seed round.
And then next second part of that question is just about negotiation. Should people anticipate that VCs are going to try to negotiate them down to a lower price? Like we would do that in private equity. In VC, is it kind of the same way? The analogy here is like a used car for sale. I see the sticker price, but I anticipate getting a better deal. Should people go into the fundraising process with that expectation?
It's not as bad as private equity. There's not going to be that much like back and forth.
Better to come into something, lead with something sensible.
Yeah. I mean, again, expect that you're going to dilute yourself 20% and decide how much you want to raise that way. And, maybe have the conversation. I really just want to dilute myself 15%. Right. And that's kind of how you lead with it. And
so then to the point of pricing, the next question is, what's the best way to price your own safe? Because that's a little bit more of a fugazi, like valuation cap, discount. It's conditional on something that hasn't happened yet. So what's the best way to do that, to think through that?
If you're having a big VC come in, they might price it. If it's all angels, then that's a loaded question. I think about it as if, the safe cap is where the shares are going to convert, right? Ideally, you're performing better. So the next round, it'll be at a much higher valuation. I would just say try to keep it as clean as possible. You see so much safe overhang these days where people raise on 10 different valuation caps or discounts and all that. And you're just going to get screwed with legal bills down the line. It's painful. So that's my biggest advice.
Cool. That's helpful. We had someone raise their hand. I'm going to see if you want to speak up.
The first one is there's a number of ways you can actually get in touch with the VC, right? As you alluded to. One is the warm intro. Two is finding that person's email and emailing them directly. And then the third might be going through the website. The first question would be in terms of ranking, warm intro obviously being the highest, website versus direct email, which ranks higher? The second question would be on the website. I noticed you have not just a pitch deck submission, you have a fair amount of other questions. One being, for example, what do you believe about this market that everyone else gets wrong? So if you are looking at that versus the pitch deck, which do you hold higher, the pitch deck or the answers to the questions? I suppose the answers to the questions could actually give more insight into that person's thought process and so on and so forth. And thirdly, who actually looks at the pitch decks submitted through the website?
I don't think I ever read the answer to those questions. What do you think about, I mean, to be frank, however, everybody at the fund had the opportunity to look at those pitch decks, right? That went directly into our CRM, right? So I think pitch deck is most important. Short answers might get brushed under the rug. I think email, as far as power ranking of most impactful ways to get in touch, warm intro from a founder. So a founder they've backed, right? Any VC really values the opinions of a founder that they've put money into. 2 would be another investor's warm intro. 3 would be direct email outreach, right? So if you do the work of finding their email, send them a thoughtful message. 4 would probably be website, but website's always does get looked at, but that's probably just the coldest of cold.
Next question is, how important is it to show 5-year projections in a deck? Some advise yes and some advise no. What is your view? I will bite my tongue on this one to let you respond first.
I think 5-year is crazy. Everything, so much is going to change. So much is going to change. I like to see, not even in the deck, but as part of my diligence process when I was at the fund, I would like to see 2-year projections just to know the depth of thought around being able to pull 2-year projections and, understanding the different levers of the business model and assumptions made and all that, but understanding that everything's an assumption. And I think 5 years is just too long of a projection.
Here's a follow-up to that. Does it hurt you to leave projections out entirely and discuss anything related to the operating model of the business and what the next 2 years might look like once you get on diligence? Are you going to pass on someone because they left projections out of their deck?
No. If you put your deck in DocSend and you track time spent on each slide, projections are going to be the lowest besides the title slide for sure.
Yeah, of course. All right. Next question is, for teams with young founders out of college, how can we show team strength? So for a CPG startup, so that's consumer packaged goods, I believe, none of the founders have a background in CPG. Will this hurt us? And what can we do to show our team's potential apart from showing traction? So this is actually probably quite a relevant question for a lot of young founders.
It varies investor by investor. So many investors are so different in what their style is and what types of founders they like to invest in. And I think whatever you can do, whether it's looking at their portfolio and their website and understanding, the conversations could be as different as talking to your in-laws versus talking to a college friend, right? Old school, buttoned up people. We only invest in third-time founders who have been in the industry for 50 years, or people who would prefer to invest in a freshman college dropout. I just spoke with founders the other day that dropped out of they're at Caltech and Stanford and dropped out of their freshman year, and they just raised 10 million on a 100 million post with no product.
That's like the tip of the tip of the tip of the iceberg, though.
That's not smart. Yeah. There's so many problems with that. But I'm just saying, like, don't let anybody tell you can't do it because you don't have relevant experience. I think the passion and drive and taking the jump is a huge part of it. Yeah. Hustle on the validation. And whatever you can do as far as validation. Right out of college, you won't have that much money and like bootstrapping for a bit to prove it out. But if you tell an investor you went and talked to 400 people about this, they're going to feel very confident regardless of how old you are.
Anything that in your history of like reviewing businesses really sticks out as memorable in terms of what something did as a creative way to validate their business?
Yeah, no, there's a really good one. So I invested in a company that is vertical SaaS for physical security, right? So they're building like an operating system, CRM, booking platform for security guards, right? Security guards for individuals, security guards for businesses, mall cop types, right? But there's no good platform to manage that now. One of the founders went and spent 3 months working as a security guard. He used to work at Bird and Lyft before that. Like, he's a tech guy. He's not a security guard, right? But he's like, I need to learn about this market. Let me go and spend 3 months doing it. Late night security shifts, like learning all the problems. Like, that's like the extreme in terms of.
And like in the deck, you have a picture of like you with the security guard. And like, it's like, oh my God, clearly this guy went to lengths to differentiate himself. And like, that speaks miles about how capable you are. So you can get creative. It's just like, I guess as an early founder, you really need to invest a lot of your time because you don't have a lot of money.
And time, even if you have money, it's like the time investment probably means more anyways. It shows commitment.
All right, let's keep ripping through these. Next one is, what level of person is the best to cold outreach to at a VC firm? So like the analyst, the MD, or somewhere in between?
Definitely not the highest up. I think it needs to be a very, very, very compelling, thoughtful cold outreach to the highest up person at the fund. And they'll probably forward it to like the associate or the principal if they think it's interesting. You're just getting back in the pile that the associate or the principal has to begin with, right? So I would say the easiest to get into is going to be the lowest level person who's looking at deals. And then they're going to have to work it up the food chain. That's just the reality of cold outreach. I think the best you could do is get a warm intro to like a principal or a partner. Next
question here. I have a pet peeve in the VC industry. Were you a first check into Stripe, Scale AI, Space, Lyft, and AngelList?
Paige Craig who's the GP at Outlander. I was a partner there. It's not.
He was one of the first checks into Stripe and all these companies.
Yeah, he's incredible track record. Yeah.
Wow.
Yeah, people will put logos on their site. A lot of times it'll be angel investments versus fund investments. If you see like big names or older companies before the fund starting, there's validity to that question.
Next and last question that we have here, it's actually excellent timing. Is it rude and a waste of their time to reach out to VCs just to speak for 5 to 15 minutes about my startup and what they think of it? Or do you only take calls from founders whose decks you've seen and presumably like come off as more credible and ready to raise?
No, I would love to chat with founders as early as possible. I think because you want to be the one that they reach out to when you are ready to raise, right? I think that, again, that's a case by case. But if you find like true pre-seed focused funds, they're used to doing the conversation and keep it warm and, before folks are ready to raise. So it's definitely not rude. Half of the job is sourcing.
So how do you spend your day, like as an associate or a vice president and an early stage VC? Like is a productive day taking a bunch of calls that might lead to nothing?
It's sourcing, selecting, and supporting. Varies in terms of allocation of time between the 3 buckets, but think sourcing is all deal flow, taking first calls, taking second calls, et cetera. Selecting is actually doing diligence, like when the deal gets deeper in the funnel, right? And supporting is post-investment, trying to help out, checking in on portfolio companies. And, some folks don't do any supporting, some folks don't do any sourcing. Those are the 3 primary quote functions of a VC and components of the day.
All right. So we've gone through all the questions. I have 2 more questions I just think would be helpful and relevant for people before we wrap up here. The first one is about this whole AI boom that's happening. Every deck you see is either an AI startup or has an AI feature. What's the best way to think about AI implementation into someone's business, a SaaS business, and their pitch? Like some businesses need to be built and aren't AI first businesses, but you see people forcing AI features as bolt-ons to like seem compelling. How should a founder think about implementing AI into their business and their pitch, regardless of what type of business they are?
It reminds me a lot of 2021 with Web3 and crypto being incorporated into every pitch. And ultimately, no, not every company should have been on the blockchain or blah, blah, blah. It's just the flavor of the month, right? I think that AI has a lot more staying power and it will be here, and it's helping with optimization and efficiencies in running a business and lowering headcount. And you're able to do a lot more, a lot quicker with a lot fewer resources. So unless it's a true AI play, it's kind of understood, right? Yes, your developers should be using Cursor. Yes, things are going to move quicker. You'll use different tools to generate things faster, but don't slap AI on a industrials pitch deck just because you think you should.
And then last question here, what are some non-business related tough questions that you like to ask or that founders should be prepared to answer?
I always like to ask what you'd be doing if the business failed. Tells you how passionate they are about the industry. Do they want to do something else in the industry? Are they risk adverse? And folks sometimes will say they can go get a 9 to 5 very easily. You don't want to hear that. You want to hear, I'll do whatever it takes to make it not fail, or I would do something similar, but approach it this way. Lets you know that they'll pivot. I think that's really key. That might be less obvious.
Anything else?
What's the toughest thing you've ever been through? What types of adversity have you seen before to know when the going gets tough, which it will? You're building a startup. It's going to be tough at some point. How are you going to respond to it?
Hey guys, did you know we are in the middle of an algorithm hunger crisis? The algorithm survives on a diet of likes, comments, and subscribes, but it has a bottomless appetite. Like and comment on this video and subscribe to my channel to make sure the algorithm doesn't go to bed hungry tonight. I'll see you in the next one.